stock market is selling off today following some economic data that came out, actually better than expected. The recession trade is on again today. That doesn't make a whole lot of sense, but it's probably coming from the cautious warning that Fed Kashkari gave about consumer confidence, how he's watching that, and how that could be an even bigger effect on the economy than what tariffs ultimately are. We also have some comments today from Trump talking about auto tariffs, and that clearly is not helping the markets either. Here in this video, I will break all of this news down for you, put it into context, and what this means could be coming next for our markets. Now, here on the day today, we actually had some good economic data, which is surprising. I guess how you define good is, up for interpretation. But durable goods orders last month came in at 3.3%. Now, for this report, we had 0.9%, so way lower than what you had in January, but way better than the expected negative 1% decline. So I don't know if it's this that's causing Wall Street to rotate into consumer staples and out of tech. That in and of itself is normally a recession kind of trade, right? You go into consumer staples, you get out of tech, you get out of high beta, and you can see those kind of stocks selling off, again, huge today. So you don't really see that reflected from the durable goods orders. It could be some of the tariff comments coming out from the Trump administration that is causing some of the renewed, maybe recession fears. Trump, even about 30 minutes ago, an hour ago or so, says that he is preparing auto tariff announcements as soon as Wednesday, which is today. Fed Kashkari today says, I take very seriously the hit to confidence. The longer it lasts, the more meaningful it is. Fed Kashkari says the good news is that if there are resolutions of trade uncertainty, confidence could be restored. And Fed Kashkari says it's conceivable that the hit to confidence could be a bigger effect than tariffs themselves. Barclays today, they cut their S&P 500's 2025 year-end index target to 5,900 from 6,600. They kind of put this into buckets though. They say there's a 25% chance we surge to 6,700 or so by the end of this year. They say there's about a 15% chance of also going into a bear market this year with the S&P hitting 4,400 or lower. Fed Kashkari says this is the most dramatic shift in confidence in the last decade, save for the COVID era. A lot of the uncertainty shift is about tariffs. And Fed Kashkari says in the next year or two, we ought to be able to reduce interest rates further. Fed Kashkari says policy uncertainty is complicating the Fed's job. And Trump says today that we have to have Greenland for national security purposes. It was also reported that China's Vice Premier Li Feng spoke with U.S. Trade Representative Greer by a video call. So again, there's not a whole lot to go off of today. Why you're seeing that recession trade coming back into markets, perhaps it's some of the, tariff comments today from Trump, the fact that tariffs will be going into effect, that, it's not as flexible maybe as some thought, and that's going to continue to weaken out, hit the economy, or perhaps it's Fed Kashkari and his comments today on uncertainty being an even bigger kind of drag on the economy than tariffs are in and of themselves. We really don't know. Could be some of the price target reductions from Barclays and some of the other firms that we have seen in recent days. I'm not exactly sure. If you want to add your thoughts to this, feel free to down below in the comment section. But what's also super strange is TLT is down 0.5%. So at the same time you have this recession trade, bonds are not acting like, we're in this recession trade. Bond yields are actually going higher, which does not happen during recessions. And you're actually breaking down on a technical level today on TLT. So there's a lot of weird things going on today that really do not make a whole lot of sense. Now, Trump also said today that tariffs coming in April will probably be more lenient than reciprocal. He says, quote, "I'll probably be more lenient than reciprocal because if I was reciprocal, that would be very tough for people," Trump said in an interview. "I know there are some exceptions, and it's an ongoing discussion, but not too many exceptions," Trump said. So that could also be hitting markets today. Although, again, there's not a lot of clarity on, what we're looking at here, what the number is going to be. You can see on the day today, clearly the Dow is outpacing. The Dow was green for about half the day today. Did end up going red. You're down about 1/3 of 1% on the Dow. S&P is down 1.1%, but look at the nasty NASDAQ, down about 2% today. Russell 2000 down about 1%, almost in line with what the S&P is doing. The VIX is up almost 9% today. But here's the deal again. As I've said before here on this channel, the danger is right now, the VIX fell all the way down to 17.5. Sure, you're up to 18.64 today, but you were at 29. Same is true if you look at the SPY RSI. The SPY RSI is at 46 today. It got back up to neutral at 50. So this is what you see during like bear markets or the start of bear markets, where you fall a lot, you bounce a bit because the RSI gets oversold, you bounce back up to, let's call it neutral, and then you come down, hit a new low, but the RSI does not go to oversold again. It gives you more room to fall. And if that's all this bounce was, that's setting you up for a new round of lows on our markets. But again, what's fascinating is TLT is not really going up. It's going down. So people are not rushing into bonds. There's not a whole lot of fear out there, which means the correction that we are going through is probably not over. And that's one thing that I've been consistent with here on this channel. I want to see some fear before saying the correction is over with. We haven't got that. Bonds have not showed that fear. The VIX really has not shown that fear. Like extreme fear is like the VIX above 35 and spiking. The VIX just slowly climbed higher as people bought more and more puts. That doesn't scream fear the way that like December 18th screamed fear, where the VIX went up almost 100% in a day, or August 5th when the VIX went up like 200% in a day. That is everyone going out capitulating, buying puts. You're not getting that right now. So there is more room for this to continue to fall from here. And I think that's what a lot of people may not be fully prepared for. Now, today in after hours, you do have Microvision that reports earnings and Jefferies. Not really a big deal, in my opinion. Tomorrow, pre-market, you don't really have any notable names. Winnebago, if that's a company that some of you guys invest in. I don't personally. But Thursday, you have Lululemon in after hours. They cater to higher income consumers. And those are the ones that are really driving the economy these days. Okay, so if Lulu has bad things to say about the consumer, about the higher income earners, that's not going to be a great sign for the economy. Now, despite the durable goods orders we got today that came in better than expected, not great by any means, but better than expected, that didn't have that positive impact on markets, which it's not a great sign. Tomorrow morning, you have GDP growth rate quarter over quarter, final numbers for Q4. I don't expect that to move around too much. We're expecting 2.3%, but again, anything's possible. We do have the goods trades balance for February, expecting a deficit of 134.5 billion. Initial jobless claims expected at 225,000. Wholesale inventories month over month, advanced data for February, continuing jobless claims, pending home sales month over month and year over year. Kansas Fed Composite Index for March also will be coming out. You have a 7-year bond auction. Fed Barkin speaks tomorrow as well. So plenty of catalysts to give markets another move here. Friday is your big data. Core PCE month over month. We kind of already know what that's going to look like, expecting 0.3%. Personal income month over month expected at 0.4%. But again, it's personal spending. People spending money is 70+% of this economy. If people are slowing down, then that is not going to be good. Now, in January, we had a negative number. We have not gotten 2 negative numbers back to back since the COVID crash, right? Even throughout like 2022, 2023, people feared a recession. We never had 2 negative personal spending numbers back to back. If you get a negative number coming out Friday, that's going to cause a huge move for markets. And I think that's kind of what we're waiting for. And I want to pay attention to what does happen to markets over the next day or so coming tomorrow, because people are going to be positioning for that Friday's data. If markets sell off again tomorrow, then that's a sign that maybe they're a little bit nervous heading into that data. Now, what is a negative sign, at least at the time of recording this video, it looks like the SPY is below the 200-day moving average again. 200-day moving average is at $570.46. The S&P is currently at about $569. So you are below that. Do you stay below that? Obviously, I don't know. If you can get above that by the end of the day, which I think the end of the day could have a pretty volatile move, then that's going to be a good sign. But if you close below that 200-day moving average and tomorrow's another red day, you're set up for another decline on markets. CNN's Fear and Greed Index today is at 28. Kind of the same story here as well. You've bounced from being in extreme fear at 17, 18 or so. I believe we touched 16 for a period. Now you're back up to 28. Little bit more room to potentially come down is kind of what it looks like to me. Percent of stocks trading above their 50-day moving average bounced from some of the lows that you were at about 21%. Now sitting at 31.5%, down about 0.5% today. AI Investor Sentiment Survey, a new one will be coming out tomorrow, but the last one we had was 58.1% of bears, 20.3% of neutral investors, and 21.6% of bullish investors. Now, how this survey works, it's really calculated 3 days before the survey actually comes out. So you're really going to be capturing the rally, right? The rally that we've seen from the lows. So you should see the bulls drop off pretty significant, or the bears drop off pretty significantly, and the bulls pick up quite a bit. A number over 30% would not surprise me. Again, that kind of pushes back on the whole narrative that people are so bearish that markets need to rally. So you can see how you're kind of setting yourself up for a series of lows followed by bounces, followed by new lows. And again, you can even see with Barclays, like lowering their price target. They have now a 15% chance of a bear market. I think the odds of that are probably higher, right? I think the pressure on earnings is going to be maybe a lot more than people think. And that puts us in a dangerous kind of position because we're not priced for that. As much as people, scream about recession on CNBC, you're not priced for one. And if that's the direction we start to trend in, or even maybe stagflation, that's going to put some pressure, a lot more pressure on stocks for that matter. Now, TLT, I think, is also having a pretty important day today. You've established this trend line, and now today you're below that. If you can get a close above that again, then that would be a good sign for bond yields. But they just continue to be under quite a bit of pressure in the last couple of weeks as stocks have been selling off. So it's not like, again, people are rushing into bonds as protection. That's what happens when there's fear. They're selling bonds, they're selling stocks. Like, there's not a whole lot of fear out there. Okay, so that gives me a little bit of pause as well. And as I've said before here on this channel, when the SPY gets down to 500, then I feel a lot more confident. I like the risk reward setup for markets at that level. I think there's additional 20% upside, 20% downside at that level. Now, again, Barclays today says the SPY could hit 440 in this year, 15, 20-ish% chance of that. That would be a decline of about 22.5% from current levels. So even some of your big Wall Street firms starting to flip a little bit and grow more nervous. And that's kind of what I don't like about this market right now is the SPYs at, call it 569. Barclays says you have upside to 590 on the SPY this year. That's 3.63% from current levels. Call it 3.5%. So you have 3.5% upside, but Barclays says the downside could be 22.5%. That's 7 times more downside potential than upside potential. I don't like that backdrop in this market. Now, they do say best case scenario, you're getting back up to 6,700, but the odds of that, I think, are pretty low given the pressure you're going to see on margins and profitability this year. So with all of that said, ladies and gentlemen, let me know your thoughts on this down below in the comments section. Have a great rest of your day, and I will see you in the next one.